Bloomberg Audio Studios.
Podcasts, radio, news.
Christopher Ailman. He's a CIO over at CalSTRS, overseeing more than $300 billion in assets under the portfolio. And Chris, let's start off with those rate cut expectations, because as you know, a lot has changed over the past 3 or 4 months when everybody thought we were getting 4 or 5, maybe 6 cuts this year. The market right now only pricing in 1, though the Fed still has 3 on its dot plot.
Well, and Romaine, you've got to look. You hit it on the head. Back in December, they were looking for 6, then 3, now 2 and 1. Market has to readjust. So this has been a huge change and a shift. It's actually taken it in stride. I'm not surprised April's been so tough. Look how strong January, February, and March were in the market. It almost got ahead of itself. So, the Fed's going to be data dependent. I think we've adjusted to 5% interest rates up here. And the economy's doing okay. So I bet they're going to continue to hold for a while. That's news to the market. It's got to adjust to that.
Well, what is the psychology in the market? I mean, there's been a lot of discussion here about that some of the sell-off that we saw in April was really a lot of folks just kind of protecting their profits from the first quarter. And then, of course, there's the seasonal factors. If you believe in the whole, sell in May and go away idea, that we could see maybe the price action get even worse over the next couple of months.
Well, I think you hit it on the head. Old adages still hold true, Romaine, and sell in May, go away, because the market is kind of choppy. It's gotten ahead of itself. We have to see earnings. I mean, like you said, we're waiting for Amazon in a few minutes. And the earnings have been okay, but not spectacular. AI is expensive as they build it up, and so far none of us are paying a lot for it. So the revenues will come, but it's the market reassessing its expectations. I think we're in a good place, but I think the market's going to go sideways. You can easily have a 10 to 13% sell-off in a bull market year. So people have to be ready. This market could be choppy during the summer. We've got the election. The Fed's going to be data dependent.
Chris, I asked this question on radio. Cameron Christ writes great stuff for MLive. He writes a column every day, and his first line today was, one of the basic principles of successfully navigating financial markets is that you should only date, not marry your positions. And the question I was asking is, what position should you date right now, and which one should you marry?
Alix, I actually heard you this morning driving in, listening to the radio, and that was a very interesting discussion because I'm going to make a shout out to my wife, Robin, 40 years this month of May. So commitment. I think you stay married. And I think I'm a long-term investor, Alix, so I'm going to buy the beta of the market and hold it. And I'm okay being married to positions. I don't necessarily believe in trading and trying to time the market. And I've learned that the hard way myself. And for our fund here, we've done very well by being invested through thick and thin. Maybe you flow a little bit, but you diversify the portfolio 70-30. You hold for the long term and you stay married to your asset allocation. Don't worry about individual stocks.
70-30. Okay, what happened to 60-40 or what happened to like 60-30-10?
Hey, 60-40 went out as interest rates went down below 7%. Down to 5, down to 2, down to 0. Now we're back up to 5. So I think you can be a 70-30, and I think more people need to look at that. The baby boom has to start diversifying their portfolio. Finally, they're all in their 60s, and yet they love equities. So I think you've got to really see that fixed income has a return. But 60-40 is in the past. It's 70-30, 80-20 is what the typical pension plan is, and then a typical endowment is 90-10.
I am curious. Well, let's fold in also private capital into that, Chris. I mean, CalSTRS, of course, was at least one of the bigger pension funds out there to kind of gravitate into the private equity space as an allocation, as a proper allocation here. And we've seen those allocations go up pretty significantly, not just at CalSTRS, but at some of your peers as well. What is the role of that right now, particularly given the lockups and particularly given some of the concerns that the last vintages that we saw, at least for right now, haven't delivered?
Yeah, Romaine, that market is absolutely frozen. I still think there's a place for private investments in a diversified mega, and I'll call us a mega fund at $300 billion portfolio. When I got here 25 years ago, we were in the single digits in private equity and real estate. Now we're at about 15%. So let's call it 35, 40% in private markets. And I think that's the right place for us. But you're right, they've been very slow. Real estate's got to adjust to whatever is going on in the office market. and to this new level of interest rates. And I think it is. You're starting to see some transactions. But boy, private equity is just frozen in here. We're not having a merger Monday. I need you guys to be hitting the airwaves on Monday with merger acquisitions, companies selling their divisions. Then that market will unthaw. It's not so much interest rates. I think it really is a hangover of the economic shutdown from the pandemic. And we just haven't seen a lot of transactions, but they'll come back. And those markets, I think, still offer a premium over public markets for long-term institutional investors.
All right, Chris, always great to talk to you. I have to leave it there. Christopher Ailman, the CIO over at CalSTRS.